In a world where rates are high, supply is low, and money is expensive, real estate investors everywhere are feeling the squeeze. With cash flow under attack for nearly a year and the Fed showing little signs of slowing their blitzkrieg on interest rates, the populace cries for support. But who will hear that cry? Coming soon in 2024, a hero emerges. From the rubble of tight margins and non-existent yield, relief appears through the lens of a basis point bottoming out. Rumors swirl from a far-off land, but is it enough to bring hope to the tired rabble of real estate investors with nowhere to turn and nowhere to run? Could it be true? Is it possible that a rate drop is coming and the anaconda squeeze of Fed proportions may be slithering away next year? In today's show, Christian and I share news of a new hope, significant interest rate decreases appearing on the horizon. Is it true or just another falsehood that will leave investors frustrated and deceived? Find out for yourself on today's Mortgage Monday. Christian, the herald of good news that brought this to our table, I understand that you ran all night long to bring news of potential hope on the horizon. Tell me, what have you heard about a potential interest rate decrease in 2024?
It could be on. No, I'm kidding. It could be on the horizon is what I'm hearing. Man, hell of an intro, David Green, leading us into the light from the darkness.
We've got a rate update for everybody, what to expect going into 2024. So this comes right from the horse's mouth, Jerome Powell himself, out of a Business Insider article. What do you have to share, Christian?
Before we get into it, today's Mortgage Monday sponsor is Monetary Metals. Sponsors like these help us make shows every week so you guys can stay ahead in your investing game. At some point, you've probably considered buying gold or silver as an inflation hedge or to add some stability to your portfolio. But unlike rentals, metals don't make you any passive income. Until now. With Monetary Metals, you can own gold and silver while earning up to 5% per year on it, paid in ounces. First, open up an account with Monetary Metals. Next, choose which qualified business you want to lease the metals to. And third, earn passive income. If you're an accredited investor, you can even earn double-digit returns in their bond opportunities. Don't let inflation and high interest rates erode your hard-earned wealth. Diversify your holdings and earn inflation-proof income with Monetary Metals. A yield in gold, paid in gold. Head on over to monetary-metals.com/big, like B-I-G, for an exclusive offer just for BiggerPockets listeners. Now, back to Mortgage Mondays. The end of the year is always kind of fun in lending because all of the projections and the masterminds get together and kind of lay out their forecast for the upcoming year. I mean, obviously being in the end of 2023, we're starting to see these trickle through for what to expect in 2024. And they're coming from reputable sources. We're actually going to be referencing a Business Insider article, exactly as David shared, kind of some comments about what the Fed's doing and what Business Insider's analysis kind of foresee happening. And we're going to break it down for you guys, kind of give you a market update and what to expect in this next year of real estate investing.
So a lot of this information comes from the Universal Bank of Switzerland, referred to as UBS in the article. And they're making some pretty aggressive claims here. So they're saying that the Federal Reserve will shock markets with aggressive interest rate cuts in 2024. That slow economic growth would drive the Fed to cut rates by 275 basis points by the end of 2024. So Christian, can you interpret what 275 basis points is in layman's terms for the people listening?
2.75%.
Big drop.
Yeah, basis points are, we in the industry use it to make us sound smart. We're not nearly as smart as you think. It means 2.75% on interest rates.
Yes, but 275 of them is a lot of those things.
Yeah.
So a 2.75 drop in rates would be huge. And the rationale here is that the economy is going to slow a ton. Unemployment's going to go up. The Fed's going to have no choice but to cut rates massively. What do you think? Do you think that there's validity in this? Do you think people should hold their breath and wait for these huge rate cuts that could be coming at the end of 2024?
I want to add an asterisk to this because it's not so much that this is what we expect to happen. It's that this is the direction the conversation is taking. That's how I like to think of things, right? When you start seeing articles like this pop up, very rarely are they right on the dot, right? I mean, what they were saying in 2022 was not right on the dot, right? It's just when you start seeing things, in 2021, 2022, we started hearing Fed's going to start pumping rates. Rates are going to increase. Nobody said I anticipate rates to be 8% by the end of 2023. Nobody said that. If you can find me an article, please post it in the chat below because that would have been unique, right? But everybody was saying, oh, we're expecting 5%, 6%, right? So just the fact that these cracks in the armor, so to speak, are starting to show. And this is the Universal Bank of Switzerland and Business Society. These are reputable sources. Basically, this is all tied in the assumption that this, year-long, more than a year-long now, trajectory of increasing interest rates very rapidly is starting to show some impact both on growth of GDP as well as employment. And as we continue into 2024, if you guys can think of every everything the Fed does. Like if I can just break it into one sentence, it's a seesaw. And on one side is unemployment and on the other side is inflation. And the Fed's job is to keep them as close to in line as they can. You don't want high inflation, you don't want high unemployment. It's to keep both of them relatively healthy, so to speak. What happened in these last couple of years is that inflation went high. If you guys follow the market, unemployment is like historically low. So they're saying we can sacrifice unemployment coming up a little bit to bring down inflation, which is what they've done by cranking rates. I know there's a whole lot of, does raising rates actually decrease inflation? That can be argued. But the idea is they're basically trying to impact unemployment to slow the growth of the economy. And in doing that, they're hoping that less buyers leads to lower inflation. So in 2024, we're going to start to see the equalizing of that seesaw. That's where we're going to see if unemployment comes up, that means the Fed can get less aggressive, bring down rates, which theoretically, along with inflation and everything else. And who benefits when rates come down? Obviously, home buyers, people who utilize debt to grow their portfolio, everybody in our world, right? BiggerPockets benefits, right? If this ends up being a proper prediction, it's questionable what it'll do to the housing market because is everybody jumping in, with their shirts off again? We'll see, right? It could be another bloodbath similar to 2020 and 2021 where everybody was 100K over offer, right?
We should also mention that the federal funds rate is not the same as mortgage rates, though Correct. They do tend more or less to go up together and down together. They are not the same thing. And for some context here, the Fed currently has the federal funds rate set between 5.25 and 5.5. A 275 basis point drop would bring it down to 2.5 to 2.75. That's a very, very big drop. So how do we use this information to prepare for 2024, Christian? If we do see a rate drop, what would you expect to see in the market?
So number one, everybody who bought a house in the last year and a half, 2 years, there's going to be a refinance opportunity, right? So if you have a high interest rate and you were trying to float it for the meantime, what I would say is get on a follow-up list with the loan officer that you know. If you used us to close your loan, we kind of do this automatically. We set rate reminders, but reach out to us, let us know, hey, I just want to track when the rates get to 5.5, I want to refi. Okay, we can do that, right? We can set a stop point, right? So you don't, you can capture that savings. And if you're thinking of buying, I don't want to use fear tactics. It's not always right for everybody to buy, but is there going to be more competition if rates go to 4%? Just speaking as truthfully as I can here, for those of us who were actually in the market, I know, people listening to this were probably familiar with what was going on, but I'm talking about if you were offering and buying real estate in 2020 and 2021, maybe I don't speak for everybody, but I don't want to do that again. Right? That was wild. Every house had 30 offers on it. You had to offer 100K over the appraised value. You had to waive contingencies. So is there an advantage to getting into a property now, knowing that these are starting to materialize as the projections of where the next year's going? I mean, I don't think anybody would forecast. This is basically a halvening of the rate. As David shared, we're at 5.25. Cutting it by 2.75 is more than half of where the rates are right now. You're literally slicing rates in half. So that equilibrates to us being 4 to 5% interest rate on mortgages again, right? If we cut half of where we are now, I think everybody would agree that if we end up at 4% rates again, prices aren't going to drop. So it's going to have a worsening impact on our already overinflated housing prices, right?
I would add, I think they probably need a cut that severe if they want to get things going again. And here's why. We typically focus on interest rates affecting the affordability of the home. So the higher rate obviously equates to a higher payment, making it harder for people to pay more for a house. So the theory would be that, okay, prices can't keep going up if it's just that expensive to buy a house. What I don't think they plan for, and they never do, is the supply side of the equation. They only focus on the demand. What they found was that as rates went up, people said, well, I don't want to sell my house and lose my 2.5% rate or my 3.5% rate and go buy one at 8. So I'm just going to keep my inventory off the market. That withdrew supply from the market. So even though demand went down, supply went down even more, and it made houses even more expensive. So now the prices aren't going down and the rates are 2 to 3 times higher than what they were before. If you want to get the sellers who are keeping their houses off the market to put them back on the market, you have to cut rates so close to the rate that they currently have that they feel like selling their house and buying another one is roughly equivalent to the rate or the mortgage that they were paying before. So if you just drop it by a point or two, people aren't going to move. If your rates are at 8, you drop them to 7 or 6, but they're sitting on a 3, they're still going to stay tight. You get down to 4, some of those people will start to say, okay, now I can see it makes sense to get the house I'd rather have, move to another state, do whatever people normally want to do in a healthy market. So I wouldn't be surprised if we saw something like that happen. And the last piece I want to add here is every time I hear someone give an opinion, I'm less interested in the opinion, and I'm definitely not as interested in if the opinion matches what I think, because what do I know? I always want to know, what is the logic behind their opinion? What are they basing this off of? What's the perspective they hold? And UBS shares that in the article. They basically say, hey, coming into 2024, you're going to be having another election. You're going to have a historically wide budget deficit and a fractured political landscape, okay? It's going to be very difficult to get the executive branch of government to support what the Fed is doing as a new president is coming in and the economy is getting tougher and tougher. Typically, presidents and their cabinets want the economy to look like it's doing well. So the Fed's going to be getting pressure from the president, whoever that's going to be next year. I need you to lower rates to make me look good. We're also going to have a huge budget deficit, and we already have a ton of debt. The more that the Fed raises the rates, the more expensive the money that we owe the people that bought our treasury notes is to pay them back. So you often hear people say, well, China owns a lot of our stuff. We owe a lot of money to China. We have to pay China back with more expensive dollars when the rates are high. If we bring rates back low, we are actually it's like controlling the interest rate that you pay the credit card company, oddly enough, which makes it hard to keep them high. Do I think it's going to drop 275 basis points? I don't know. And if it does, that's just going to create different problems. You're going to get some solutions and new problems, like you said. Before we all rejoice and go, yes, that's great, rates are going to be low, remember that means you're probably going to have incredible demand over a still limited supply of real estate assets. So if that does happen and you're an investor, my advice would be, if you're waiting to buy, jump in quick. Don't wait to see, are they going to keep coming down even more, because you may find that there just isn't any supply for you to be able to buy. Christian, if people want to reach out to you to learn more about what you do, how they can get a mortgage, or what you think is going to go on with the economy, where can they go?
All social medias, my handle's at The One Broker, and obviously on our website, theonebrokerage.com, the contact us tab in the top right of the screen. That'll get you in contact with our team.
Yep, you can find me at davidgreen24.com or davidgreen24 on all social media. But here's something you may not know. We at BiggerPockets have an incredible library of information that you can access. We've got an entire forum, the best real estate forum in the world, bar none. You can learn so much about real estate just from perusing that. We've also got blogs where you can read about, you can get different opinions on the state of the economy, strategies that would work in that economy, what the Fed's going to do, where rates are going to do, all that and more. There's also an incredible library of books that BiggerPockets Publishing has released. You can find those all at biggerpockets.com/store, including several of mine. So I'd highly encourage you, if you like the information in today's show, to go to biggerpockets.com and start exploring the website to see what else you might stumble upon that you like as well. Thanks so much for being here. Please make sure you subscribe to the channel and like this video, and we will see you on the next episode of Mortgage Mondays.